Whoa, a lost decade for the French FAMA factor models. This is huge. And this, my man Larry Swedroe had written it, an article about a week or so ago in the Advisor Perspectives online blog. And I want to I haven't read it yet. I haven't read it. I got suckered in by the headline, which I'll share with you right here. All right, hold on a second. There we go. A lost decade for the French FAMA, or FAMA French factors. And I want to share with something. I had read a book by these guys, Eugene Fama and Ken French, and they've gone on to fame with DFA, Dimensional Fund Advisors, multi-factor explanations on asset pricing anomalies. This is from the Journal of Finance from 1996. There is a book on these guys that I had read too, and I have a hard time finding that off the top of my head here. I kind of looked, a brief cursory look on Amazon, and I came across a FAMA, Eugene Fama book that he had done on the FAMA portfolio. Wasn't the same thing. They had a book on this, and I can't quite remember. But anyway, so I typed in a DuckDuckGo French FAMA 1994 because I remember it was there was a book they had, and I just can't find it. Anyway, so the French FAMA three-factor model right there. I could have sworn there's a book that my professor had given me in 1994, 1995. But anyway, be it as it may, this is what got me into, let's read right here. The French FAMA French three-factor model explains over 90% of the diversified portfolio's returns compared with the average of 70% by the capital asset pricing model. I've never liked to cap them. I've never liked it. It's kind of like the Phillips curve in economics. They find positive returns from small size as well as value factors, high book to market, and relative ratios. Anyway, so what the factors models are is three things: low price to book. That means the price relative to the liquidation of the firm is low. The high dividend yields and low PEs. That's the three factors. So when I saw this article by Larry Swedroe from Buckingham, I said, "Ooh, this is gonna be." This is financial porn for me because, like I said, this is what established my investing as my man Howard Block, my professor, economics, God rest his soul. He liked me for some, I guess, because I was a veteran, I think, and most of the kids at George Mason were younger, and I was actually intrigued by economics and investing. And he went to eat at his house a couple times, met his beautiful wife. He nominated me for Economic Student of the Year at George Mason, which I won. George Mason is a pretty well-known economics field, and I was a Student of the Year in 1996, I think, because Dr. Block recommended me for that, which is pretty cool. Anyway, big fan. He was an older man. Now he's gone. But all right, so let's talk about this. The Dateline 5/13/2020. The poor performance of the FAMA French factors of the last decade, that's value stuff, has led many to question the existence of the premiums. But new research shows that those 10 years were not unique, that factor-based investing has prevailed following periods of underperformance. I needed to hear this because I will never get rid of my value base. I can't do it. It's kind of like once you subscribe to a theory, global warming, for instance, you cannot not be a global warming hysterics. You just can't. It's like it goes against your nature to see another way. It just does. And this is the way I feel about French FAMA and the value factor, because I cannot make light of high PE ratios, low dividend yields, and high price to book. I just can't see how that could be effective in a long-term strategy for investing. I just don't see it. Much attention has been paid to the decade to the teens, 2010 and 19, saw negative annualized returns to the French FAMA size and value factors. The two newer so now there's 5 factors now because I guess their underperformance, so the 3 made them add a couple more. The two newer factors, investment and profitability, both produced positive annual returns, though both are well below historical averages. The 4 factors together produce a slightly negative annual return. The performance was particularly poor relative to the annual return for the market beta premium, well above its historical average. All right, so that won't make sense. We'll keep reading into this. In 2020 March, David Blitz observed that the negative performance of the famous French factors of the decade was not that unusual, demonstrating that as a virtual repeat of the decade 1990 to 1999. I've told you this. I've told you. I remember I was at Vanguard, and people were wanting ahead of the value investors, even though they were putting in double-digit returns. They want. I was taking 120 calls a day at Vanguard. I hate that guy, the Neff who ran Windsor Fund. I forget John or Bill Neff. I always forget, but one of those guys. I think it was Bill, maybe John. Anyway, Mr. Neff ran the Windsor Fund since 1967. He was kicking butt, taking names, producing double-digit returns year over year over year. They hated that guy because in the late 90s, he was yesterday's news, an old grumpy old man, it seemed, and they wanted his head. I remember that like it was yesterday, and that was where I said, huh. And then I remember the aughts, the value stuff went well. Just look at Wellington, for heaven's sake. I know Wellington's got some bonds in there. I get it, but I'm just saying, Windsor looked good. Wellington looked good. It's the growth stuff that got crunched. During that period, the average annual premiums were size, negative 2%, value, negative 13%, blah, blah, blah. Together, the four French family factors produced slightly negative average annual return. That negative performance was also particularly glaring that the average annual market beta premium was 12.76, well above historical averages, just like we're dealing with this in the last decade. Blitz also observed that during those decades, the annual average momentum premium was positive from 1990 to 1999 and 3.4% from 2000 to 2019. So again, trend and momentum. There is legitimacy to that, but it's like just like let me print myself up. It's like if you look at football, there's momentum. They got the momentum until there's a holding call, and they got the momentum until Brady throws a pick, and then there's no more momentum, and then the momentum goes on the other side. So momentum works until it doesn't. When will it not work? Nobody knows. That's what makes it insane. You just can't say, well, they got the momentum, they're going to win. No, it works until it doesn't. Given the results of the last decade, investors should ask about the returns of the French family factors over the decade following the 1990 to 1999 period. From 2000 to 2009, the average factor premiums were those were well above historical averages, in stark contrast with the average annual negative 1.77 for the market beta, the market as a whole. Valuation spreads between value and growth are at levels very similar to what they were at the height of the tech bubble and near the 100% globally. Historically, after such periods, value has strong performance. That's why I can never give up on VTV. Reviewing these results should not lead one to conclude that the famous French factors are dead. In fact, they make the case for diversification among factors, including momentum, which is strongly negatively correlated with value. Yeah. The more the momentum, the less value. I mean, it's literally that simple. It's like almost like bonds and yield prices and yield and interest rates. It's like a seesaw. The higher the momentum, the less inherent value there is. The other conclusion you should draw is that patience and discipline are required. Yeah, good stuff. Could not agree more. Let's see, they got some comments in here. They usually have some pretty good comments and advisor perspective. Every now and again, I'll go and chime in just to kind of tick people off because I'm just a guy literally in my basement. All right, so here's Alan Roth. Big fan of Alan Roth. To my knowledge, neither French nor famous stated factor tilting was a free lunch is compensation for taking on more risk. As of yesterday, Morningstar shows the average 5-year return of small cap value with an annual loss of 8%, with large cap growth gaining 9.68. Yeah, it's 100% right. So we have almost a 20% difference in returns between small cap value and large cap growth. That's a big deal. That's a big deal. That's for 5 years. At some point, people say, I can't take this anymore, and they capitulate and they go, here, I'm not doing it. Look, I don't have anything small cap value. I get small cap growth. I got large cap value. And then I got some probably right in here with my VDIGX. But my biggest holding by far is VTV. It's all right here. So if you look at large cap growth versus large cap value, large cap growth is dominated for 5 years now. Well, it's not even close. But if you're contrarian, you'd want to be on this side of the equation, not on this side of the equation. But I'm telling you, a lot of new guys, a lot of YouTubers, they don't. What's the word I'm looking for? They don't follow this the history of the markets. They just don't. They don't study it like they should, and that's concerning because a lot of people are going to go with a winner, and you go with the winners until it becomes the losers. Then you lose your money. Brian Fenn, I'd beware of using that Morningstar data from their site. As far as I know, anything past 1 day returns haven't been fresh in a while. Blah, blah, blah. This is from, I can't really read that. And here's Ray Benton, not sure. Hi, Larry. Blitz's conclusion differs considerably from yours. It seems that more factors are needed for an accurate, comprehensive description and cross-section of stock returns. And he seems to be indicating that perhaps in order to accept the pricing efficiency of the markets, we must use many factors beyond the French famine. All right, here's Larry. All right, so first in my books, I provided risk-based explanations for the value premium with dozens of papers providing the evidence and logic for that. French famine called them, in fact, risk premiums. As second, the volatility of the premium has been like 4 times that the premium itself, so long periods of underperformance should not be unexpected. The exact same thing is true of market beta or growth. Its volatility is about 2.5 times its premiums, and it too has long periods of underperformance. All right. The interesting thing is that basically 100% of the underperformance of value recently has been due to what Bogle calls a speculative return, the change in relative PEs. So it's not because growth companies have outperformed in terms of earnings. It's relative to their PE, their expectations. I 100% agree. Look, I'm in with Bogle and Swedroe here without question. Let's see what else we got here. Thanks for pointing out this, Brian. That's concerning, Alan. That's Alan. That's concerning. Okay. Attaches Cliff Asness presentation from today shows that the spreads are not just wide, but a historical 3 to 5 standard deviations high, and the spreads are not arbitrage way because of pain of quantitative value. Okay. All right, Ray, to me, the most important part of this presentation for Cliff Asness is that we've been through here and done this before. At 100% right. With that said, one would expect that an economic crisis like the Great Depression, value would underperform as these are riskier companies. Oh, man, so right. So right. Let's see if we have anyone else in here that I'm familiar with. This guy says, I've become hard on value tilting the relative underperformance of real return. In the real world, the client expectation retention is definitely a difficult conversation to broach when other asset classes show considerable growth year after year, especially over the past 5 years in comparison to value. Academia understands this concept. However, real world clients only see one thing, returns. Yeah, I completely agree. All right, so I do want to talk a little bit about this. Value stocks are riskier stocks. There's a reason the prices are low and the dividend yields are higher. The price to books are lower and the PEs are lower because they have, for some reason, the growth opportunities have been minimized. For some reason, they have something has happened to make them come out of favor, to make them value. If you look at the equation, you got growth on this side, value on this side. Sometimes what was growth are now value. Because something went wrong. GE comes to mind. What is GE? I guess the markets are closed today. What is GE doing right now? Let's take a gander. Last I checked, it was like $7 or something like that. I have not checked for a while. So GE is at 641. It's $6.41. And that's up from its low of 5.48. Right? Now here's the issue: GE has got no PE. They literally have no earnings. They're running cash flow deficits. That's for sure. Or they're not running positive earnings. They're running losses. And they still have and their yield is only 0.62. So they're not making any money. They have no earnings. And they cut their dividend significantly. Yeah, earnings per share negative 32 cents a share. So GE, would that be considered a value stock? I don't even know how you consider it a value stock. It's got no PE, but you'd have to say it's a value stock, which means it is, if it does, it's like a sandfish or whatever those are called, flounder. It's scaling along at the bottom. Now, if it can come off the bottom, it could boom and you could make a ton of money, but it might go bankrupt. We don't know. We don't know what's going to happen here. But that's where value stocks give you the upside, because if they do survive, they can make you a lot of money. But some of them are going to go kaput, which is why you never buy a stock on the value side. You buy the whole index, and that's VTV for sure. Anyway, so always remember, value stocks, even though they look historically better over time, they're riskier. There's just no getting around that. There's a reason they're value. They're value because something has happened negatively to affect the price. And that could mean it's more likely to go bankrupt. I bet if you did a study, I haven't done it, you look at value stocks versus growth stocks, I bet value stocks more often than growth stocks go bankrupt. I bet you can see that. So be careful, but I'm sticking with my value stocks just because I still believe. I'm a true believer. Come hell or high water, I believe. All right, we'll see you.